I'm also, Hi, I'm Ron Paprocki, President and CEO of MEDIQUS Asset Advisors, and I'm also the treasurer of the DuPage Medical Society Foundation.
And hello, my name is Julie Kazan, and I'm the Vice President of Financial and Investment Strategy at MEDIQUS.
Managing appropriate planning strategies plays an important role in accomplishing the major goals of estate planning. It's our pleasure to walk you through leaving a legacy, estate and charitable planning. The goals of estate planning often are the idea of minimizing taxes and other expenses, distributing assets to the individuals and organizations you wish, and doing so in a meaningful manner. We find that charitable planning also plays an important role in total wealth management coordination and is often as important as items such as investment consulting and the management of your other advisors. So that's what we'll cover tonight, and we hope that you enjoy this session. So Julie, you want to take it from here?
Sure, thanks, Ron. All right, we're going to start the recording, and once the session is over, Ron and I will be available to answer any questions that you may have. And thank you for joining, and we hope you find the session educational. Thank you.
Before we get started, we want to remind everyone that if you make a $350 donation to the DuPage Medical Foundation, MEDIQUS will complete a no-cost second opinion financial review. We will look at where you are today in terms of your goals and let you know if any adjustments need to be made to ensure you are on track. The DuPage Medical Foundation is a great cause. It promotes the education, health, and well-being of DuPage County residents. The foundation provides scholarship grants to healthcare students from DuPage County. So you can give to a great cost and get a no-cost second opinion financial review with a value of at least $750. Let's look at our agenda for today. We will be focusing on two areas: estate planning techniques, which will focus on the various ways you can include giving in your estate and what type of assets might be the most appropriate assets to consider for such purposes, and lifetime giving techniques, which will focus on the various ways lifetime gifts can be made and the limits you might want to consider as you plan your gifts. Let's start this section of our session by offering perspective on estate planning. Then we'll wrap up with how charitable gifting can play a role in your estate plan. First, why plan your estate? There could be several reasons to do so, but the most typical reasons we identify are: you may feel it's an important task to provide income necessary to the standard of living to surviving family or friends. You may want to make assets you have accumulated during your life are distributed to the people or organizations that are important to you. Wish to minimize the potential of estate taxation. Federal estate taxes have become much less burdensome for most individuals. However, these favorable laws are expected to sunset or change in a few years. In addition, states also have tax structures that should be considered. And finally, you may want to provide specific bequests or gifts to various charitable organizations that are important to you. Regardless of the reason why, the process can appear to be overwhelming. However, with appropriate steps, the seemingly complicated process becomes very straightforward. Understanding the estate distribution process and subsequent taxes is a good first step. Let's review. Let's look at the process. To begin, understand that as you accumulate assets, they fall into one of four basic categories: personal property, such as cars, boats, bank accounts, or investment accounts. Next, real estate, your residence, a summer home or winter home, perhaps a commercial building, office building, or apartment complex. Next, a practice or business interests. These are unique assets that can be valued and distributed in various manners. And finally, tax advantage assets. These are assets with unique income tax treatment during life or at the time of death. Most notably would be a retirement account, such as your IRA, 401k, pension, or profit-sharing plan, as well as life insurance policies. At the time of death, the bulk of these assets can be pulled into probate. Probate is a period of temporary receivership historically created to allow creditors an opportunity to make claims. Before assets can be removed from probate, taxes and expenses may have to be paid and paid in cash before whatever is left available to the people you're primarily interested in, your family or friends. A question many ask is how might these assets be protected so your estate planning objectives can be accomplished? Distribution of assets will do much to help accomplish your estate planning goals. There are various types of distribution methods. Let's take a closer look. Distribution can depend on several variables such as title of ownership, beneficiary designation, or legal documents. Ownership can be in the form of solely owned, jointly owned, as community property, or as tenants in common. Beneficiary designations are important to control assets such as life insurance policies, retirement plan accounts, or some bank or brokerage accounts that have a transfer or payable on death arrangement. These are specific arrangements allowing you to name a beneficiary for these types of accounts. Legal documents, and a quick word about legal documents, they only control distribution if the form of ownership is appropriate and if there are not any beneficiary designations. This is a common area of misconception. Many individuals prepare elaborate estate documents that don't control distribution simply because ownership or beneficiary designations will supersede the control of legal documents. For example, a will typically controls distribution only if the assets are owned solely, one name, and if there is no beneficiary designation, such as payable or transfer on death arrangements. A trust typically controls distribution of assets that have been titled to the trust prior to death or that are to be paid to the trust at the time of death. All taxes are due and payable in cash within 9 months after death. And here's a simplified federal tax table for 2022. As you can see, there is a substantial amount of property that can be distributed to individuals other than your spouse without paying federal estate tax. Currently, the amount available is $12.06 million. Once you exceed that amount, taxes begin at 40%. And remember, this estate tax structure will sunset after 2025. In the meantime, Congress can change the estate tax law again. You're a resident of Illinois and leave behind more than $4 million for deaths occurring in 2022, your estate may have to pay an Illinois estate tax. And please note, while the federal estate tax allows the surviving spouse to use the deceased spouse's unused portion of the exemption, a feature called portability, Illinois state tax does not offer portability between spouses. Each spouse has an exemption amount of $4 million. Below are some examples of potential Illinois state taxes based on the size of an estate. As mentioned, estates below $4 million will not owe an Illinois state tax. Estates of $5 million can have an estate tax of approximately $285,000, and estates of $10 million can have an approximate tax of $927,000.
Thanks, Julie. Now that you have this basic information as it relates to an estate planning process, it's important to apply this knowledge based on your stage of life. For example, if you're in your early career phase, we typically see the following issues are key for estate planning. The identification of guardians, executors, and trustees is an important first step. These individuals are most likely going to play a role for a more extended period, especially if children or other heirs are young and will require management or income for an extended period. Identifying the appropriate need for income provided to heirs is critical. In this case, evaluating standard of living requirements, potential education costs, and to what extent you may wish to fund retirement life will all be important variables. Next, identify available assets, especially those that can be used for income-producing purposes. Verify beneficiary designations of the assets that you've accumulated. For example, employer retirement plan accounts and life insurance beneficiaries should be coordinated with your estate plan. Next,
Identify possible life insurance requirements if the assets you've accumulated are insufficient to accomplish your goals. Most clients use life insurance as a tool to replace capital they'd hoped to accumulate before they died. Next, address management needs. Especially for early career physicians, the identification of people that can help manage assets and coordinate the distribution of income to beneficiaries in need is an important role. Finally, for early-stage physicians, charitable planning as a part of their estate plan is relatively rare. What if you're more mid-career? Once again, identifying individuals to serve as guardians, executors, or trustees is an important first step. Income needs for survivors is important, even though income needs may be different from those that are in their early stage. Same process applies, meaning identify the need addressing standard of living requirements, education costs, and retirement needs. Identify available assets. Typically, more assets are available simply because you've had more time to gather those assets. Verifying beneficiaries also an important step. Verify the distribution of assets, especially when income may not be the primary concern. For example, children may have reached adulthood and are not requiring income to support their standard of living. In these cases, distribution of assets, rather than the production of income, becomes a primary concern. Management is key, even if not required for as long a period of time as the early stage career, and charitable planning becomes a little more common with mid-career physicians. For those of you that are late career or already retired, considerations are similar. Identifying the appropriate executors and trustees, always an important step. Verifying distribution to survivors and understanding beneficiary designations is key to make certain your assets are distributed in the manner you wish. And understanding the administration of your estate and taking steps to avoid probate can be important as well. Taxation may be a more critical factor simply because the total value of assets may exceed the non-taxed amounts. And charitable gifts in an estate plan are more common in late career physicians. We typically find a current review of the total estate plan and process is critical for those in late career or already retired status. This can be a simple process, but is one that is important to verify that your plans will be appropriately executed. Charitable contributions can be an important part of an estate plan. Most typically would be a bequest to a worthy organization. It's also possible to establish donor-advised funds at the time of death so your charitable giving can be continued. Some will also consider more advanced techniques, such as charitable remainder trusts or charitable lead trusts. If a bequest is preferred, you can consider some of the examples which should be reviewed with your lawyer before drafting your will or trust. Each of the following examples can be used depending upon the type of contribution you'd like to make. For example, you can make a contribution of cash of a specific dollar amount. You may prefer to contribute a percentage of your estate or to give a residual amount after you've made specific contributions to family or friends. Or finally, you may decide to name a specific tangible asset, such as a share of stock or a piece of real estate or other tangible property, to a charitable organization. A donor-advised fund can play a part in the estate plan. Rather than funding the donor-advised fund during life, the funding occurs at the time of death by making a bequest to the donor-advised fund. No tax is paid on the amount bequeathed to the donor-advised fund, and no tax when those assets are sold. Grants can be made by individuals you have appointed to manage the donor-advised fund. This can be an excellent way to include family members in an ongoing charitable giving strategy after you have died. In more advanced situations, you may consider the use of a charitable remainder trust. While typically not part of most estate plans, they may be effective for you. The process begins by contributing property to the trust, which results in a partial income tax deduction. The charitable trust pays income to you or to other individuals during their life, with the remainder passing to charities at the time of death. Another technique is the charitable lead trust. These are structured to allow a contribution to the trust, which makes yearly payments to charities, and the remainder is paid to family members after the certain period. These are more complicated arrangements and require careful legal assistance to make certain all is prepared correctly. To wrap up, let's recap some of the items that we've discussed. Distribution of assets is key for all stages of career. Make certain that your assets are inventoried and that you identify your beneficiaries and charities. Administration is key for all stages as well. Probate should be avoided if possible and can be avoided with the appropriate titling and legal arrangements. Management becomes key as well for all stages to make certain that you've identified who needs such management, what kind of management is required, and for what period. Income objectives should also be identified, critical for early and mid-career physicians, especially when young children are part of the family. In these cases, it's important to also identify who would be in need, how much income is required, and for what period. Finally, taxes and charitable bequests. Key at all stages, especially as it relates to both federal and state taxation.
Thanks, Ron. There are several techniques individuals use for making charitable gifts. Some are very easy to execute but offer limited income tax benefits, such as gifts of cash, check, or using credit cards, while others are a bit more complicated but provide potential benefits that you might want to consider, such as gifts of appreciated securities, the use of donor-advised funds, or qualified charitable distributions, or gifts of life insurance. Let's explore these in a bit more detail. The best way for individuals to make gifts is to either donate cash, write a check, or charge the gift on their credit card. A very simple process to get an amount to your preferred charity. Gifts like this generally qualify as a charitable donation and as such might be able to reduce your taxable income and thus have the potential to reduce your income taxes. However, just because a gift can be considered a charitable donation does not mean you will receive a tax benefit because of the recent changes to the standard deduction available for many taxpayers. A bit more on this later. There are also techniques that can qualify as charitable donations, just like the simple techniques previously described, but also offer the potential plus of additional benefits that can save you money or make your plans for giving much easier to accomplish. The use of donating appreciated securities, using a donor-advised fund, or using qualified charitable distributions all fall into this category. Let's look a bit deeper into each of these. Appreciated securities are items such as shares of stock, mutual funds, exchange-traded funds, also known as ETFs, or real estate that have increased in value since the date of purchase. Such appreciation is usually not taxed until the asset is sold. Generally, the gain, very simply the difference between purchase price and selling price, is taxed at a long-term capital gains tax rate, typically 15%. Some individuals may think they should sell such an asset so they can have the cash to give to their favorite charity. That could be a costly mistake. For example, let's assume an asset was purchased for $10,000. Over time, it appreciated to $40,000. If sold, the gain is recognized and taxes are due in the amount of $4,500, 15% of the gain. Appreciated securities can also be used for charitable contributions. The full value of the appreciated asset can be considered as a charitable gift. Using the same example, the full value of the appreciated security is available as the gift of $40,000. Below is an example of how donating an appreciated security can work. An appreciated security is donated to a charitable organization, and the donor has a charitable deduction based on the market value of that security. And then the charity can sell the security because they are a charity and there is no income tax paid on the sale. A related strategy is found with the use of a donor-advised fund. This tool can be combined with a combination of appreciated securities and the ability to make gifts to multiple organizations in a very simple manner. Donor-advised funds are easy to arrange and can become very effective tax planning and charitable giving tools. Let's use the same example of the appreciated security we just described, an original investment of $10,000 and a current value of $40,000. However, rather than wanting to make a single gift to a single charity, let's assume you would like to divide the impact of that gift among many charitable organizations important to you. How can you use this asset to help multiple charities or make charitable gifts over several years? Well, let's review. Let's review how a donor-advised fund works. Let's assume you own stock that has appreciated in value. If you wanted to give the value of that stock, you could sell the stock and pay capital gains tax, and the remaining value is available for contribution. However, you can also donate the stock to a donor-advised fund. The contribution of the stock can create the charitable deduction equal to the fair market value of the stock donated. Once received by the donor-advised fund, the fund can sell the stock and not pay any capital gains. Why? Simply because the donor-advised fund is considered a charitable entity. The proceeds from the sale can be reinvested, and then you are able to direct grants from the donor-advised fund to the charitable organizations of your choice. For example, the DuPage Medical Society Foundation. Of course, other various qualified charities can also benefit by such grants. Now, be aware that administrative fees and investment fees may apply, and it's important to consult with your tax advisor regarding your own situation. For those who are age 72 or better, you are probably aware that the government requires you to take distributions from your IRA accounts and possibly from profit-sharing accounts or 401k plans. They allow assets in such accounts to not be taxed until you begin to withdraw the funds from your account. Assets in these accounts can be used to help you make more tax-efficient charitable contributions. Based on current law, up to $100,000 in total can be directed to any number of qualified charities each year. By doing so, you are not required to claim these withdrawals from the account as income. Special attention is required to maintain appropriate records in the event of an IRS audit. For example, the IRA account owner instructs their account custodian to make a distribution in the name of the preferred charity. No charitable deduction is available, but no income tax is paid on the distribution as well.
Thanks, Julie. For our final lifetime giving example, let's consider the potential gift of life insurance policies. Why gift life insurance? Consider why you purchased the policy. What circumstances or individuals were you trying to protect? It's possible the reasons you purchased the policy no longer exist. If so, a gift of the policy can make sense. One reason many purchase life insurance is to create an estate. For example, let's assume you purchased the insurance to protect your young family in the event of your death. You needed to create an immediate estate so they would be cared for. Another reason many purchase life insurance is to preserve an estate. Estate taxes may have caused a substantial drain on assets in the event of your death. Insurance can be an effective tool to produce the liquidity needed to pay estate taxes in a relatively inexpensive manner. Insurance needs can change. Your previously young family has grown and all are self-supporting individuals. In addition, you have saved substantial assets. Mission accomplished. You have created your estate. The insurance is just not needed any longer. And recent changes in tax law have lessened the burden of estate taxes, so much so that the need for the life insurance may also no longer exist. There are two basic ways to use life insurance as an asset for gifting. Transfer policy ownership to the charity. A few things to keep in mind. Such a transfer is irrevocable. It cannot be undone. The deduction that is available is generally equal to the cash value, if any, of the policy. And of course, the question which needs to be answered is, who pays future premiums? Another option is to name the charity as the beneficiary of the policy. Benefits here are that that decision is revocable. You can always change your mind and change the beneficiary. Unfortunately, no deduction is available simply for naming a charity as a beneficiary to the policy. What about the tax implications of these alternative giving strategies? Let's take a quick look. Gifts of cash to public charities are deductible if they do not exceed 60% of adjusted gross income. Gifts of appreciated securities are deductible up to 30% of adjusted gross income. If your gift exceeds these limitations, there is a 5-year carry-forward period for you to deduct as much of the gift as possible. Let's get a better understanding of the concept of carry-forward if a charitable contribution exceeds deductible limits of either type of gift. As an example, let's assume an individual's adjusted gross income is $200,000 and they contributed $100,000 of appreciated securities. The 30% limit of an adjusted gross income of $200,000 is only $60,000. Therefore, only $60,000 of the $100,000 contribution is allowable as a charitable deduction. The remaining $40,000 can be applied to the next year's tax return. Substantial charitable contributions can still be made with some income tax deductibility, but may have to be spread over a few years. Our final item to review is the standard deduction. This is an amount all taxpayers can use to reduce their taxable income, even if they do not have any deductible charitable gifts or other deductible expenses. Currently, the standard deduction for a single person is $12,950. Married filing jointly, $25,900. Taxpayers who are at least 65 years old or blind will be able to claim an additional 2022 standard deduction of $1,400. Given all we have the ability to use the standard deduction, it is possible to maximize the benefit of using this amount, and doing so can be used in combination with more advanced charitable giving strategies such as a donor-advised fund. For example, let's assume in year 2022, a married couple has a charitable deduction of $15,900. In addition, they have other deductible expenses, such as mortgage interest or state property taxes, of $10,000. Total deductions are $25,900, which happens to be the same amount as the standard deduction. If all remains the same for 2023, they will have the same amount of deductible expenses. Total expenses and total deduction for the 2-year period is $51,800. But what if they bundle their charitable deductions into 1 year rather than spreading out over a 2-year period? Same total contribution of $31,800, just all made in 1 year. The result is a higher deductible amount in the first year and the use of the standard deduction in the second. The result is an additional $15,900 of deductions with the same expenses as the first example. It can make sense to bundle. To summarize the points presented so far, consider creating separate entities such as donor-advised fund. This can be a simple way to potentially combine other strategies to make gifts to several charities. If over 72, consider the use of qualified charitable distributions as a tax-efficient method of making charitable gifts. Consider the use of appreciated securities for charitable giving. This helps you eliminate capital gains taxation on the assets. Finally, use gifts of cash, checks, or credit cards as the last resort. Easy to use, but with very limited additional benefits. It also makes sense to consider the documents that will be used in your estate plan. Let's start with your will. Your will is a simple document that basically directs any assets that are not controlled by title or a beneficiary designation. Usually, a will leaves personal property to the surviving spouse or family members and will distribute any remaining assets into the trust arrangement if one exists. The living will may also be created. This document will express your preferences for life support. A trust, whether living, created during your life, or testamentary, created as part of your will, can also play an important role. Remember, a trust can be in existence for many years and provide management and the vehicle for the distribution of income or assets to family, friends, or charity. Power of attorney documents are important to maintain as well. These can provide temporary authority to individuals to control property or healthcare decisions on your behalf. Finally, I suggest a document that has no legal significance but can have a tremendous impact on those that survive. I suggest you gather some nice letterhead, a good writing instrument, and lock yourself in a room for the afternoon. I suggest you write a letter, but not a letter like any you've written before. This will be a letter that will be read by family and friends after you've died. This is an opportunity for you to say one more time how much you love them, what you hope they will achieve, and what happiness you hope they will find. It's a last chance to say those things you may not ever have the opportunity to say. If you've ever been given a letter such as this, you'll know the impact it can have on a life.
Everything we've talked about today is part of a larger formula to success. Financial success is a combination of investing, advanced planning, and relationship management. Investing is not just about choosing the right stocks, bonds, and mutual funds. It is about getting your allocation right and mitigating risk as much as possible. Advanced planning involves wealth preservation, wealth enhancement, which includes cash flow management and tax mitigation, wealth transfer and making sure your money passes at your death to the people you care most, asset protection. We live in a very litigious society, and unfortunately, many physicians have targets on their backs. It's important to make sure as many of your assets as possible are protected in the event you are sued. And finally, charity, and making sure you're giving back in the most efficient ways possible. And the final piece of the formula is relationship management. Are all of the financial professionals on your team communicating and working as one towards your goal? Is the left hand talking to the right? Your financial professionals should be in contact and discussing the best ways to assist you on a regular basis. If you are looking at this formula and are unsure if you are doing the right thing in any of these areas, you are not alone, and we are available to help. Our experience has been that 4 out of 5 physicians and their families cannot say with confidence that they are doing the right things. We'll mention it again here. If you make a $350 donation to the DuPage Medical Foundation, we will complete a no-cost review. What's included in the review? Well, we will complete a retirement section. So based on the age you want to retire and how much income you want each year, we can tell you how much you need to save and help you identify what accounts to use to reach your goals as efficiently as possible. We will complete a risk management section where we will calculate if you have adequate amounts of disability and life insurance. We will evaluate if long-term care insurance is something you should consider. If you have children and want to save for their college educations, we will calculate how much you need to save and can help identify the right 529 plans to use. Investment analysis, where we will review each of your investments to determine if they are performing up to standard and if fees are controlled. And we will provide any recommendations or changes that you should consider. And we'll also help you determine out the all-important asset allocation mix. And finally, we will do a basic asset protection and estate planning review. Do you have assets unnecessarily at risk if you are sued? Or do you need wills, trusts, and power of attorney documents? Again, all of this at no cost, a $750 value if you make a $350 donation. Help a good cause and get some help yourself.
Thank you again, Julie. I appreciate your help. And thank you all for participating, and hopefully you were able to gather a few important points. We'll be glad to remain available to respond to questions as they develop. Thanks again.
I see that we, excuse me, had a couple of questions that came in through the chat here. So we're happy to answer those. And then any other participants, feel free to either type a question or speak your question, and we're happy to answer them. And Kate, if you wouldn't mind, can you start our videos back up? Okay. All right. Well, we can just answer the questions without video. Oh, thank you.
There you go.
And here, Ron, all right, Ron, you should be able to turn on your camera as well now.
Great. Thanks.
Here we go.
Thanks, Julie.
Makes it a little nicer to chat.
No doubt.
All right, great. And Ron, can you see the questions that popped up here?
I can. Would you like to answer that first question about RMDs?
Sure. So Dr. Wilson, if you turn 72 September of this year, so you can either take your first RMD by December 31st of this year, or you can delay taking your first RMD until April of next year, but then you will have to take 2 RMDs in 2023. And then Ron,
And
if
for
you
that
want.
reason, we generally don't recommend postponing that long, because that extra RMD distribution might pop you into a higher tax bracket. So it's just a question of estimating what your income will be next year versus this year, and factoring that in. Remember that those that are 72 or better have the opportunity to apply up to $100,000 of their required minimum distribution to a charitable organization. If you do so, you do not pay income tax on the amount of money that's used for that qualified charitable distribution. That's the term of art that's used for those types of distributions from your IRA. Let's see, Julie, there was another question about the individual and their spouse have annual charitable contributions of about $50,000. And since they filed together, does that mean that their charitable giving is bundled and all can be deducted? Well, the answer to that is that if charitable contributions, excluding any qualified charitable distributions from your IRA, equal that $50,000, then you should have that $50,000 as a deductible expense that's applied to your tax return. Remember, if you made those contributions this year and you postponed or didn't make any contributions next year, then most likely the standard deduction would be applying unless property taxes and charitable contributions in 2023 exceed that amount. So in effect, that's true. Just remember, qualified charitable distributions from an IRA, they're not included in that $50,000 amount that might be deductible. Why? Because you did not pay income tax on that amount. Then, Julie, I see one more question. May I pass the ball back to you?
Oh, sure. How much of your IRA must you take out? So Dr. Wilson, it's based on an actuarial figure calculated by the IRS. I'm happy to send you a table that illustrates how much of your IRA you need to take out each year. That figure adjusts based on your age each year. So it's not necessarily a percentage, it's actually a figure that you divide your IRA balance by to determine how much you need to take out each year.
Then Julie, we have another item that popped up in the chat area. And first, thank you for the compliment. That one of you really enjoyed the presentation. I hope more did as well. The question is, would you be able to talk about defined benefit plans, GRATs, which is an abbreviation for grantor retained annuity trusts, and whether they're regularly used by clinicians? And the answer is, well, first, the defined benefit plan could be a very effective way to accumulate more substantial amounts for retirement purposes. A defined benefit plan is an ERISA, a qualified retirement plan that's either sponsored by an employer for the members of the practice, or if an individual is in some type of solo activity, whether it be through consulting, expert testimony, or things such as that, they may be able to create their own defined benefit plan, which allows them to contribute quite a bit to that type of structure, much more than the typical 401k limitations. Is it appropriate to use? That really depends on what your income would be from those sources and whether or not you might have to include other employees at the practice in such a plan. They can be very effective. They're a little bit more expensive to administer than the traditional type of 401k plan or profit sharing plan, but they can be a nice tool to use if they do apply. A couple of layers that you do have to be aware of just to make certain that you're not incurring an expense unnecessarily. So hopefully that gives you some guidance on that. The grantor retained annuity trust, that's certainly a possibility to use. Again, a lot of that depends on just what an individual is trying to accomplish as far as an estate plan is concerned, and whether or not the grantor retained annuity trust or a charitable lead trust or a charitable remainder trust that we covered in the programs, if they may be more effective depending upon the individual's objectives. I don't know, Julie, is there anything else that you would add to that comment?
No, I mean, I think speaking with your estate planning attorney can really give you a better idea if this type of structure, this estate document makes sense for you, just because, as Ron mentioned, it really just depends on what your individual goals are, not just for today, but for your future and for your beneficiaries' futures as well.
But we have seen those implemented. It's not a common strategy to use, but in the right circumstance, it can be pretty effective. Thanks for your question. Let's see, any other questions that we can respond to here? It looks like that kind of wrapped it up, but certainly if there are any others or anything comes to mind later, please feel free to reach out to us at MEDIQUS. We're glad to be able to provide any information. We've maintained a long and hopefully helpful relationship with the DuPage County Medical Society, helped with the reserve funds, that have written articles. We believe educating physicians is a pretty important thing to do, so always glad to do so. But for now, I think the important thing is to stay hydrated. Oh wait, that should be coming from a physician, but be careful in the heat and do enjoy your evening. And thank you again for sharing some of your time with us.
And just and one more thing, as a thank you for coming and listening to this